Let's talk to Dean. He's in Kelowna, BC. Hi, Dean.
Thank you, Mark.
You're welcome.
Dave, Mexico, it's been down, and I'm just wondering whether it's a little early to get back in there, and if it is a good time, would you go the ETF, EWW, or Union Pacific, or whatever you tell me how you would make some money out of Mexico here. Thanks, Dave.
Okay, so let's start with the big picture. Clearly, through the course of this year, it's been a developed market year versus emerging markets years. And it's interesting because if you look at early in the year where a lot of the flows were going was into emerging markets. But starting with China and then working its way all the way through emerging markets, one by one they broke down as we went through the spring. Mexico was about the most resilient of the bunch, hanging in until sort of May when things really came apart. The reason for that is that in the Mexican economy, first of all, it's the most underlevered developing country, I mean, I guess you'd call it a developing country, that there is at the consumer level and at the government level. So debt levels are not a problem there. And second, it's a very young population with more people under 60 than any developed or developing country. So the demographics are good, the balance sheets are good, consumer spending is pretty good, but it certainly got caught up in the emerging markets sell-off. I think it's early to say that there's a shift back to emerging markets. I do think that we are in a more developed market right now. But Mexico is a very strong tie to the U.S., which is such a strong market globally. So if I were going to have anything that was outside of sort of the U.S. And maybe some stuff in Europe, I think Mexico would be something that's quite interesting. A good way to play it is that ETF, EWW. You can also buy rail exposure through UMP. But EWW, I think, is probably the best way to play it.
Does it interest you to have exposure in that part of the world, or it doesn't matter to you?
Well, you know, we did have exposure earlier in the year. We wound up getting stopped out of it. We made some money in individual positions, but we got taken out of a bunch of them. We are left, as it stands today, with a very strong concentration in the U.S. stock market, which is, we think, the most logical place to be. We have very little in Canada. We have almost no emerging markets exposure currently. Now, this earnings period is going to be really important because there's a lot of strategists calling for an acceleration in the back half of the year. If that's the case, then you should see a pickup in emerging markets. But you'd look for a pickup in commodities. You'd look at a pickup in a bunch of things. I don't think that's so evident yet. I would just wait and go through the earnings period before I started layering stuff like that in.
All right, David. Next up is Peter. He's in Brampton, Ontario. Go ahead, Peter.
Hello. Thank you for taking my call. I'd just like to ask Mr. Burrows' opinion on IBM.
Sure. So, Peter, IBM is in the right neighborhood because tech as a group is showing some strength, predominantly large cap tech. If you take the 7 or 8 biggest technology companies, there's a bunch with very low payout ratios, good dividend policies, and very good free cash flow generation. IBM probably is not the best choice in the group right now. Strangely enough, Microsoft is behaving particularly well just because of the huge cash flow generation. If I had to buy a large cap tech name, you're not buying it because you think there's lots of growth. You're buying it because you think you're going to get nice dividend increases, and it's a pretty stable balance sheet. So I like the sector, and I think you can focus there. I think you can look at things like the ETFs, like XSD, which is the semiconductor ETF, or the Triple Q, which is the NASDAQ 100. Both of them are behaving very well, but I'd be a little bit careful with IBM right now.
Did you get a chance to look at Microsoft's big reorganization today? And if so, would you?
I haven't had enough time to pull it apart, but certainly it'll be interesting over the next little bit.
All right. Next up is Larry. He's in Toronto with a question. Hi there, Larry.
Hi, Mark. Hi, David. I'll be brief. AG&C, I've held it for 2.5 years. What I'd like is your opinion on the recent jump, not to mention the fall. Having held it for 2.5 years, a ton of it, as well as an alley, do you own it? Where is it going now? What is the net book value? Would you buy it now? And where will it be 2.5 years from now, in your opinion?
Right.
I'll hang up and listen, and thank you for taking the call, Mark.
Sure.
Thanks, Larry.
Good night, Joe.
So for those that don't know, American Capital Agency is a REIT that holds residential mortgages. And so, of course, when you get a spike in mortgage rates, like 30-year mortgage rates gone from like 3.3% to 4.6% in the U.S., it's a big jump. What that's caused is a significant tailing off of refinancings, and it will also cause a pickup in early payments. And so this is a levered play on residential long-term mortgages. And so it is one of the spaces that naturally a concerned investor who's concerned about rising rates might step away from. And so I think at this point it's too early to say that rates have gone too far. I think they're more likely to be range bound, but this is not going to be the most logical spot for those people who think that you might want, dividend growth and less interest rate sensitivity. It's highly interest rate sensitive. So in general, we don't own any mortgage REITs at this point. I would liken it to owning fixed income, and I think it's probably not the place to be. I'd rather have the dividend growth.
But you held some of these in the past?
Yeah, absolutely. In a different kind of market where with interest rates stuck at low levels, absolutely.
And the Fed's bond buying or mortgage-backed security buying affects these too, doesn't it?
It does, and the Fed does not want to see a significant spike in mortgage rates. But that being said, we're going through one of those right now.
Mm-hmm. Okay, David, a short pause. We'll get to your past picks right after this break.